Hello and welcome to the investment review for March 2013. So the end of the tax year is upon us, and this gives us time to focus on any unused reliefs before the 5th of April. The obvious candidate for this is the ISA. The maximum stocks and shares ISA allowance for 2012-13 is £11,280. And if you've not yet utilised all of this allowance in this tax year and you wish to make an investment, or maybe you want to make an early investment ahead of the increase in allowance to 11,500 for 2013-14, please contact us for advice and recommendation. With regard to pension contributions, these are always being meddled with, and effective from 2013-14, the maximum pension contribution allowable for tax relief at your highest rate reduces from the current £50,000 to £40,000. Unused allowances from the previous 3 tax years may be carried forward to maximise your pension contributions. So if you're thinking about making a substantial pension contribution before the end of this tax year, please contact us urgently to discuss your individual circumstances so that we can assist you with the calculation of your maximum allowable pension contribution. For additional tax rate payers, this is the last chance to obtain higher or additional rate income tax relief by making a pension contribution by the 5th of April 2013. Salary sacrifice is an effective way for employees and employers to make savings on tax and national insurance, and increasing the employer's pension savings at the same time. By sacrificing part of your salary, this part is paid into your pension scheme directly by your employer, and in addition, as part of the deal, a willing employer could also pay all or part of the national insurance savings into the pension scheme. The savings and benefits are particularly beneficial for higher or additional tax rate payers, but this arrangement may not suit everybody, and therefore it's always advisable to seek advice before making any commitment. Continuing with the end of tax year theme, the financial year end for many companies is the 31st of March. Apart from the obvious benefits of maximising pension contributions, they can significantly reduce corporation tax bills as well. Turning now to capital gains, the annual exemption for capital gains in 2012-13 is £10,600 per individual. If you're considering disposing of an asset where you may be liable for tax, which is 18% for basic rate taxpayers and 28% for higher rate taxpayers, if possible, consider transferring the ownership of the asset to a spouse or civil partner if they pay a lower rate of tax than you before the sale takes place. Venture capital trusts and enterprise investment schemes offer alternatives to potential capital gains tax savings where the tax bill could be significant. But these do carry a high risk to capital because you're required to invest in small businesses. Similarly, transferring assets between spouses may also have income tax saving benefits, especially when one spouse is a nil or a basic rate taxpayer. Inheritance tax planning is another contentious area, with the government having frozen the inheritance tax threshold. But there are some modest ways to reduce your inheritance tax liability without giving all of your assets away. The annual exemption of £3,000 allows individuals to make gifts without any implications during their lifetime or on death. In addition, regular funding of a pension scheme for a child or grandchild could also be exempt under the normal expenditure out of income exemption. Now turning our attention onto news items, there have been some social healthcare reforms which came from the Dilnot Commission's report on social care costs. The government has now issued details of new measures that it hopes will give peace of mind to those needing care, that their costs will be limited and that they will get the care that they need. The draft bill looks a little like this. From April 2015, a national minimum eligibility for threshold care and support in England will come into force. This makes the system fairer and more consistent and allowing people to move between their local authorities. No one will have to sell their home during their lifetime to pay for their residential care. From April 2017, a lifetime cap on eligible care costs comes into force, that being £75,000. Eligible care is assessed by the local authority, and once the cap has been met, the local authority steps in and pays for your eligible care costs for the rest of your life. Working age people will benefit from a lower cap, and under 18s with care needs have a cap set at 0. The cap does not include general living expenses such as food, accommodation and utilities. This will be set nationally and is expected in 2017 to be around £12,000. You can choose to pay for more expensive services, but these will not count toward the cap. What you will pay toward care costs depend on your assets and your income, and currently those with total assets of less than $23,250 get some help with paying the costs. From April 2017, it's proposed that those with property and savings of up to $123,000 will be entitled to receive financial support. This does go some way to improving the current arrangements. The Dilnot Commission report stated it expects 16% of older people to face costs of £75,000 or more. Capping the amount that everyone will pay for their care will go some way to redressing the imbalance of the unfairness that exists in the current system. Turning now toward economic comments, there have been recent large inflows into equities as investors are being forced to take risks with their money if they want to achieve returns on their capital with the prime aim of beating inflation. The reward for taking risk has conventionally been measured against safe government debt, and this results in something that's known as the risk premium. A recent report from Barclays has shown that safe haven assets have halved over the past 5 years, and that investors taking risks by investing away from safe haven assets are not always receiving the premium for taking these risks. The graph below demonstrates the differences in holding equities, gilts, and cash over the past year. Troubled European countries such as Spain and Italy saw their sovereign bond yields rise due to perceived concerns about their creditworthiness. The results of the Italian election are disappointing because at the time of writing there is a stalemate which has immediately seen falls in the stock markets. Italian government bond yields rose sharply, indicating markets are now wary of lending to Italy. The austerity measures implemented by the unpopular Mario Monti had shown some successful results, so this political stalemate will have a backward effect. It's likely that the country will consider holding another election. To date, the European sovereign debt crisis has not spread to the United States, UK or Japan, despite their similar debt levels, because they have monetary autonomy and the ability to influence their individual currencies, helping to address confident issues about government debt sustainability, and will still need to make changes to fiscal policy over the coming years. In the UK, where investors sought security by investing in gilts during the economic turmoil, yields on gilts have now fallen so low that they are not keeping pace with inflation. This is reflected on the previous graph. The Bank of England may decide on further QE, which is predicted to be around 25 billion, bringing the total to an eye-watering £400 billion. Recent research on the impact of government funding for lending scheme has shown that where some lenders are drawing on these cheap funds, they no longer need to rely on attracting investors, and this means that interest rates to cash depositors have fallen. The UK lost its AAA rating, leaving just Canada and Germany as the only industrial countries with AAA status. Mounting concerns leading up to the downgrading resulted in the pound falling to its weakest level against the euro for 16 months and against the dollar since July 2010. When the USA and France lost their AAA ratings, their markets did not react significantly, and the same has been true of the UK, where it was expected. In fact, it is hoped that the loss of the AAA rating will lead to fiscal stimulus opening the way forward for UK growth. Low growth of 1% is predicted for the UK for 2013, while the government focuses on debt reduction, and low interest rates are expected to continue until at least 2017. In summary, as you know, we constantly continue to keep abreast of market movements and economic and political news. However, our ethos is not to chase returns by immediately reacting to such news, and instead we tend to take a balanced view of the overall economic outlook and seek returns by using a suite of investment portfolios matched to an individual client's objectives and appetite for investment risk. The forthcoming budget on the 20th of March may spring some surprises to raise revenue, and obviously we'll make comment on this in our next bulletin. In the meantime, thank you for listening, and obviously if you have any questions, please feel free at any time to contact us. As usual, all of our contact details are on the next slide.